Today, we are zooming in on the actual nodes, the business quadrant of CapitaLand Integrated Commercial Trust.
Or CICT for short.
Right, CICT. So for those of you following along on our journey, welcome back. This is segment 2 of our comprehensive deep dive series into CICT. And as always, we are pulling directly from the source material. So today we've got CICT's updated July 2026 presentations.
We've also got the Q1 2026 business update.
Right, and the massive FY 2025 annual report, plus some incredibly revealing notes from their 2026 annual general meeting.
If you strip away the branding and just look at the geographical coordinates of their Singapore portfolio, it becomes instantly apparent.
They are running a transit-oriented development strategy.
TOD, yeah.
TOD. It looks less like a real estate portfolio and more like a map of the mass rapid transit system.
It really does.
Okay, let's unpack this. Because if you treat commercial real estate like a giant game of Monopoly, CICT seems totally obsessed with only buying the railroad properties.
Or the squares immediately touching the railroads.
Exactly. Of Junction 8.
Seamlessly connected to the Bishan MRT interchange. And that philosophy, it scales perfectly into their downtown and integrated spaces, too.
Yeah, look at Ion Orchard.
Right. They own 50% of it through a joint venture, and it is physically integrated into the Orchard MRT station, serving both the north-south and the newer Thompson East Coast lines.
So I was trying to figure out why this specific strategy matters so much, and the occupancy rates just slapped me in the face.
The numbers are incredible.
Incredibly robust.
Yep.
In Singapore, these properties are sitting at mostly 95.7% to 98.7% occupancy.
Which is functionally full.
Places like Tampines Mall, IMM Building, BDOC Mall, like you said, basically full, 98.7%. So why does this specific transit-oriented strategy result in such high occupancies?
Well, it has to do with the specific environment of Singapore.
Right. Car ownership is restrictively expensive by design, thanks to the certificate of entitlement.
Exactly. So the vast majority of the population is simply forced to commute via train and bus.
Add in the tropical heat.
And the heavy rain.
Right. So people naturally want to transition seamlessly from a train station directly into an air-conditioned mall.
It's a perfect convergence of urban planning, climate, and consumer behavior. The environment forces the behavior, and CICT monetizes that behavior.
Wow.
By physically attaching their malls to these transit nodes, they effectively capture the commuter flow before it can even disperse.
Right, because if you live in BDOC and you commute home from the city, you are highly likely to just walk through a CICT property to get your groceries.
Or grab dinner.
Or catch a bus. It creates a legally and economically channeled funnel of foot traffic.
And when you guarantee foot traffic to your retail tenants, you practically guarantee rent collection for the REIT, which mathematically leads to that near-perfect 98.7% occupancy rate.
It's almost impossible for a well-managed mall to fail if it owns the choke point of daily life.
Exactly.
But that thesis gets a little, complicated when you look at their overseas assets.
It does. The dynamics change.
Because the data shows their properties in Australia and Germany are averaging around 91.6% to 91.8% occupancy.
Which is a noticeable drop from Singapore.
It is. Are we looking at fundamentally worse properties, or is the transit monopoly strategy just not working in places like Sydney and Frankfurt?
It is less about the quality of the buildings and much more about the surrounding urban ecosystem. I mean, honestly, a 91.8% occupancy rate in a major Western market post-pandemic is absolutely solid.
Yeah, it's certainly not a disaster.
Not at all. But it throws into sharp relief just how uniquely impenetrable the Singapore portfolio is right now.
Because the environment is different.
Right. In Sydney, with properties like 66 Ilburn Street, or in Frankfurt with Galileo, you are dealing with very different commuter dynamics.
Much higher car ownership.
Sprawling suburbs.
Completely different work-from-home cultures, right?
Precisely. You don't have that single, centralized public transport funnel operating at the incredible density of Singapore. So that 91.8% figure abroad tells us that these overseas assets are subject to more traditional competitive market forces.
Right. Tenants have choices. Commuters have choices.
Whereas in Singapore, the transit integrated assets operate almost like monopolies. They are inevitable locations.
Okay, so the Singapore locations are inevitable, and they are essentially full. But having a great building in a great location is really only half the battle.
Right. You have to look at the macro environment.
We need to examine the broader economic weather systems hitting those buildings over the next 1 to 3 years. Because no matter how good your building is, if the market is suddenly flooded with 10 shiny new buildings right next door, you lose your pricing power as a landlord.
Supply and demand. It is the inescapable gravity of real estate economics. You always have to look at the pipeline.
And according to the sources, polling from URA, CBRE, and Cushman & Wakefield Q1 2026 data, the gravity in Singapore is heavily favoring the landlords right now.
Oh, absolutely.
Let's look at the central business district grade A office market. The supply is incredibly tight. There is only one major building, Shaw Tower, which is roughly 435,600 square feet, scheduled to complete in 2026.
Just one building.
One building.
Right.
And after that, the next major supply wave doesn't even hit until 2028. Because of this drought in new construction, core CBD vacancy is sitting at a microscopic 3.3% as of Q1 2026.
To give you some context on that 3.3% number, in the commercial real estate world, we call that frictional vacancy.
Frictional vacancy, what does that mean?
It means that even in the hottest market in the world, you will always have 2 or 3% of your space empty just because tenants are in the process of moving out, or new tenants are moving in, or maybe spaces are undergoing renovations.
Oh, I see.
So a 3.3% vacancy rate means the Singapore CBD is effectively sold out. If a massive multinational corporation decides they want premium space in Singapore tomorrow, they have virtually zero leverage at the negotiating table.
And that lack of leverage translates directly into the rent forecasts. The reports project that CBD Grade A rents will grow by 4.0% to 7.0% in 2026.
Which is massive for a developed market.
It is. And the retail side is telling a very similar story. Very thin new supply at about 0.4 million square feet per year from 2026 to 2029.
The data notes this is well below the historical average.
And with tourism remaining resilient and consumer spending holding up, prime retail rents are expected to grow 1% to 2% this year.
This structurally thin supply pipeline in Singapore is just the ultimate safety net for CICT's valuation.
Because supply is artificially constrained.
Exactly. Partly due to land scarcity, partly due to strict government planning. And so the existing inventory becomes infinitely more valuable. Landlords don't have to offer massive incentives like, 6 months of free rent just to retain their tenants.
Right, because if a retailer threatens to leave an integrated hub like Boogs Junction because the rent is too high, the landlord can simply point to the door.
They know they have a waiting list, and they know there are no new mega malls being built down the street for that tenant to escape to.
But then I looked at the overseas data, specifically in Frankfurt, and it completely broke my mental model of how supply and demand is supposed to work.
Frankfurt is a fascinating case study right now.
It really is. I mean, Sydney has a high vacancy at 13.8%. But there are no new completions in 2026.
Right.
And the 2027 supply is already over 60% pre-committed. So you can sort of see how Sydney might stabilize.
Right.
But Frankfurt, the sources state, Frankfurt has an elevated overall vacancy rate of roughly 11.5% to 12.0% in Q1 2026. So lots of empty offices.
Lots of them.
Yet in the exact same market, prime CBD rents just hit a record high of 55 euros per square meter per month in Q2 2026.
A record high.
My initial thought was that this has to be a typo in the report. How is it logically possible for a city to have 11.5% of its office space sitting totally empty, gathering dust, while simultaneously the cost to rent the best office space hits an all-time record-breaking high of 55 euros?
It sounds like a total contradiction. But you have just stumbled onto a textbook example of a phenomenon called the flight to quality.
Okay, flight to quality.
What's fascinating here is that it is arguably the most powerful trend reshaping commercial real estate globally right now.
So what does a flight to quality actually look like on the ground? Because mathematically, if there's a 12% vacancy, landlords should be dropping prices to get people in the door.
Right, but you have to stop looking at the Frankfurt office market as one single bucket of space. You need to start looking at it as a strict hierarchy.
Like tiers of buildings.
Exactly. At the bottom of this hierarchy, you have older grade B or grade C buildings. These are your typical 1980s or 90s structures. Yeah. Outdated HVAC systems, poor energy efficiency, small windows, terrible amenities. Now, at the very top of the hierarchy, you have prime grade A buildings.
Premium stuff.
Right. These have platinum green certifications, state-of-the-art air filtration, end-of-trip facilities like luxury showers and secure bike racks, massive floor-to-ceiling windows, and they are located in prime hubs.
Okay, so huge difference in quality.
Huge.
Yeah.
Now, layer on the post-2020 shift in how we work. Companies are trying to mandate that their employees return to the office, right?
Yeah, getting people back to their desks.
But to justify the commute, the office has to be a destination. It has to be significantly better than working from a home office. A dingy cubicle farm with flickering fluorescent lights won't cut it anymore. Employees will just quit.
That makes sense.
Furthermore, large multinational corporations now have incredibly strict ESG mandates.
Environmental, social, and governance.
Exactly. They legally and ethically cannot sign a new lease in a building that bleeds energy and has a terrible carbon footprint.
So these major companies are essentially being forced, both by their employees and their own corporate mandates, to upgrade their real estate.
Yes. And what happens when everyone decides to upgrade at the exact same time? Companies are collectively abandoning those older, lower-tier offices.
Leaving them totally empty.
Right. They're moving out, and those Grade B buildings are just sitting empty, which is what causes the vacancy rate in the overall market to spike to that 11.5% or 12.0% you see in Frankfurt.
Wow.
But those companies aren't leaving the city. They are all trying to squeeze into the very scarce premium Grade A spaces.
Oh, wow. So you have a massive surge in demand localized entirely at the very top end of the market, and they're all fighting tooth and nail over a very constrained supply of truly modern buildings.
Exactly. That fierce, concentrated competition is what drives those specific prime CBD rents to a record 55 euros, even while the rest of the city literally hollows out.
That is wild.
It is a tale of two markets moving in completely opposite directions. The bad buildings are dying, and the great buildings are thriving.
That makes so much sense now. And it also highlights why CICT's Q1 2026 overseas occupancy softening is such a critical watch point for investors.
It is a very important metric to track.
Because the question isn't just about the overall Frankfurt market. It's about whether CICT's specific buildings, like Galileo, are the ones companies are fleeing to or the ones they're fleeing from.
Right. And given CICT's pedigree, they're obviously aiming for the upper tier.
But maintaining that premium status requires constant cash injection to ensure they don't slide down that hierarchy.
Absolutely.
Which transitions us perfectly into figuring out who exactly is inside these buildings. We know the macro markets generally favor the landlords, especially in Singapore, but who is writing these massive rent checks every month?
And are they locked in?
Right. We need to do some tenant profiling to measure the heartbeat of the cash flow.
Risk mitigation is really the name of the game here. You want to see a diverse tenant base so that if one sector of the economy takes a hit, the entire REIT doesn't go down with it.
And looking at the source data, the risk mitigation here looks honestly spectacular. The tenant concentration risk is incredibly low.
Very low.
The absolute largest single tenant across CICT's entire empire accounts for less than 5.0% of their gross rental income, or GRI.
Less than 5%. That's fantastic.
Yeah. And if you aggregate the top 10 largest tenants combined, they only make up 16.0% of the GRI. That leaves a massive 84.0% of their income spread out among thousands of smaller tenants across retail and office spaces.
That is a tremendously well-diversified base for a commercial REIT of this size. It provides a massive shock absorber for the dividend.
But, there is a detail in the recent reporting that honestly frustrated me as an analyst.
Oh, what was that?
The transparency has completely vanished. The sources note that in recent quarterly updates, specifically the Q1 2026 business update, CICT completely stopped naming their individual top 10 tenants. Or disclosing their specific percentage of GRI. Here's where it gets really interesting. The last time they published that level of granular detail was way back in the FY 2023 annual report.
Yeah, they pulled back on that data.
And my initial reaction was just annoyance. Because as an investor, you want to know exactly whose names are on the leases. Is your biggest tenant a rock-solid sovereign wealth fund? Or is it, a tech startup burning through venture capital that might go bust next week?
It's natural to want to know that.
But I realized, mathematically speaking, the underlying sub-5% metric is so strong that the names almost don't matter.
Exactly.
If the biggest tenant is less than 5%, it means no single company going bankrupt, even if they totally collapse overnight, can sink CICT.
Right.
They could lose their biggest client tomorrow and still retain over 95% of their revenue. It's an absolute fortress.
That is the correct way to view it. Analysts always hunger for more data, but we have to recognize why management obscures it. Often they hide specific tenant names to protect their own negotiating leverage.
Oh, to keep competitors in the dark.
Right. If competitors in the market know exactly who is paying what and exactly when their leases expire, those tenants become a hunting ground for rival landlords offering cheaper rents.
That makes total sense.
But you are right. The sub 5% metric is the structural safeguard you rely on, regardless of the actual names on the door.
So the diversification is solid. But let's look at the temporal risk. Like, how long are these tenants actually sticking around? This is measured by WALE.
The weighted average lease expiry.
Right. Basically, how many years are left on the average lease across the portfolio? The portfolio average sits at 3.0 years. But when you break it down by segment, there's a massive divergence.
A very intentional divergence.
Retail has the briefest WALE at just 1.9 years. Office space is sitting at 3.1 years. And integrated developments lead the pack with a long WALE of 4.3 years.
Right.
My first instinct as a casual observer is that if I'm a landlord, I would want everyone locked into a 10-year lease so I can just go to sleep, collect the checks, and not worry about vacancies.
Most people would assume that.
Yeah, I originally thought they were keeping retail leases short because retailers are risky businesses that go bankrupt often. But given the constrained supply in Singapore, could it be that they are keeping WALEs short intentionally, just so they can hike rents more frequently?
That is exactly the mechanism at play. A lease is fundamentally a fixed contract. Let's say you lock a retailer into a 10-year lease at a fixed rent today.
Okay.
2 years from now, inflation spikes, construction costs soar, and that specific neighborhood suddenly becomes incredibly popular.
You're stuck.
As the landlord, you are trapped. You are missing out on all that upside because you are stuck collecting yesterday's rent in today's much more expensive world.
Wow. So with a retail WALE of just 1.9 years, CICT is constantly cycling through lease renewals.
Yes. And remember, the macro environment we established earlier, Singapore retail space has very thin new supply.
Yes.
So every single time one of these short 1.9-year leases expires, CICT has immense leverage. They can look the tenant in the eye and say, the market rate has gone up. Your new rent is 5% higher. If you don't want it, someone else does.
That's brutal, but effective.
Shorter retail leases allow landlords to aggressively capture upside and manually adjust for inflation in a constrained market. It is a built-in inflation hedge.
Okay, that makes perfect sense for capturing upside. But if shorter is better for jacking up the rent, why on earth are integrated developments sitting at a much longer 4.3 years? Why surrender that pricing power?
Because integrated developments operate on a different scale of gravity entirely. We are talking about massive properties like Raffles City or an Ion Orchard.
Crown Jewels.
Exactly. These developments live or die based on their massive anchor tenants. Think of a huge multi-level department store, a sprawling flagship tech store, or a massive corporate headquarters occupying the attached office tower.
They need stability.
Right. These anchor tenants don't just move in. They spend tens of millions of dollars fitting out their spaces. They build custom staircases, install massive lighting rigs. They will not commit that level of capital expenditure without the absolute certainty of a long-term lease to amortize those costs over a decade. Furthermore, the landlord desperately needs those anchors. A flagship store is what draws the immense foot traffic that supports all the smaller retail tenants, the ones with the 1.9-year leases.
So it feeds the whole ecosystem.
Exactly. So you trade a bit of short-term pricing flexibility on the massive anchor tenant in exchange for the long-term stability and gravity they bring to the entire property. The 3.0-year blended average suggests management is balancing that short-term aggression with long-term stability quite effectively.
This is a two-part move. First, the divestment. They are selling Asia Square Tower 2, or AST2, located right in the heart of Marina Bay.
A prime location.
Very prime. Now, crucially, this is a leasehold office property. They are selling it to IOI Marina View for $2.476 billion.
It's a huge transaction.
Now, what stood out to me is the premium. They were selling it at a 9.9% premium to its December 2025 valuation.
Nearly 10%.
Yeah. And for the listener, the exit yield on this sale is approximately 3.0% post-tax. That essentially means the annual income the building was generating for CICT was about 3% of that $2.47 billion sale price. They are walking away with an estimated net gain of roughly $199.9 million after expenses.
We should really pause on that divestment for a moment, because selling a mature asset at nearly a 10% premium to its book value in today's economic climate is a massive win.
Because valuations can be tricky, right?
Right. Real estate valuations on a balance sheet are often just theoretical numbers concocted by appraisers. Actually, finding a buyer with $2.4 billion in liquid capital willing to pay a 10% premium, that proves that those valuations aren't a fantasy. It shows immense institutional demand for prime Singapore assets.
So they have this massive pile of cash from selling a Marina Bay office. What are they buying with it? This is the second part. The acquisition.
And what an acquisition it is.
They are buying Paragon on Orchard Road. Now, unlike AST2, Paragon is a premier freehold integrated development.
Freehold being the key word there.
Exactly. They are buying it for a total outlay of $3.919 billion from a Temasek-linked entity called Cascade & Peak. The entry yield on Paragon, the income it will generate relative to the purchase price, is 3.9%.
It's a very solid yield for that location.
I was trying to conceptualize this because as $3.9 billion is a number so large it kind of loses meaning. So think of it this way.
Yeah.
Imagine you currently own a leased luxury sports car. It's flashy, it's parked in a great neighborhood like Marina Bay, but it's a lease. Eventually the clock runs out, the value goes to zero, and you have to give the keys back.
Right.
And the return you were getting on it, the yield, is decent, but somewhat low, around 3.0%. Now imagine you get a surprise offer from someone willing to buy out your leased sports car for way more cash than you thought it was worth.
You'd take it.
You take that pile of cash and you trade it in to outright buy a timeless freehold mansion on the absolute best, most prestigious street in town, Orchard Road.
And this mansion actually pays you a higher return.
Exactly, a 3.9% yield. And the financial math entirely backs up the trade. The sources note that this move provides a plus 2.1% DPU impact.
DPU being dividend per unit.
Right, the actual cash payout that investors receive. Meaning, if this transaction had been completed on January 1st, 2025, the dividend paid out to investors would have immediately jumped from 11.58 cents to 11.83 cents.
An immediate boost.
They are trading up in quality, securing a freehold asset, and instantly boosting the cash in the pockets of the shareholders.
Oh.
And because they are buying it from a related entity, Temasek-linked Cascade & Peak, it's classified as an interested person transaction. So it does require unit holder approval at an EGM.
Which is standard protocol.
But I have to stop and push back on how they are paying for this new freehold mansion. Because while the AST2 sale covers a chunk of it, $3.9 billion is a huge price tag.
It leaves a gap, yes.
The sources are very clear on the funding mechanism. Alongside debt and the AST2 proceeds, CICT is launching a private placement of at least $600 million. They're pricing new units between $2.292 and $2.332 per unit. And the sources explicitly note this is a placement, not a rights issue or a preferential offering.
I see where you're going with this.
Wait, a $600 million private placement? If this is such a brilliant, accretive deal that boosts dividends and secures a trophy asset, why shut the door on the everyday retail investors who have supported the REIT for years? Why not do a rights issue to let regular mom-and-pop investors buy these new shares at a discount alongside the big guys?
It is a very common and honestly completely valid frustration for retail investors. If we connect this to the bigger picture, to understand the mechanics here, we have to look at what happens when a company issues new shares.
It dilutes the existing shares.
Exactly. It dilutes the ownership of existing shareholders. Your slice of the pie gets smaller unless you're given the right to buy more shares to maintain your percentage. A rights issue or preferential offering allows every single retail investor to do exactly that.
So why not do it?
However, we have to look at the institutional power dynamics from the management's perspective when they are trying to close a staggering $3.9 billion mega deal. A rights issue for retail investors is a slow, cumbersome, and heavily regulated legal process.
Lots of red tape.
Tons of it. It requires drafting and printing massive prospectuses, mailing them out to tens of thousands of individual retail investors, waiting weeks for them to read it and make a decision, processing thousands of small payments, handling all the administrative errors.
That sounds like a nightmare when you're trying to move fast.
It is. And in a volatile stock market, the share price could crash during those 3 or 4 weeks of waiting, which would jeopardize the funding for the entire $3.9 billion acquisition. A private placement, on the other hand, is lightning fast. Management calls up a handful of sovereign wealth funds, major pension funds, massive institutional players. They negotiate a slight discount on the share price to incentivize them, and they can raise that $600 million in a matter of hours. Boom. Done.
Wow. Just hours.
The funding is locked in, the execution risk is completely taken off the table, and the massive acquisition can proceed with absolute certainty. So while retail investors rightfully feel left out of getting discounted shares, capital markets are structured to reward speed and certainty. Management is prioritizing the safety of the mega deal over the equity of the retail investor, knowing that ultimately the rising dividend benefits everyone.
That's a tough pill to swallow if you're a small investor hoping to grab some cheap shares, but it makes brutal corporate sense. When $3.9 billion is on the line, Speed and certainty will always win.
Exactly.
So they are buying, they are selling, and they're upgrading from leasehold to freehold. But that's not the only way they're growing. CICT isn't just swapping existing chess pieces on the board. They are actively forging entirely new ones. Let's look at the Hugang Central Greenfield development.
A very interesting pivot for them.
Because looking at the sources, this represents a pivot in their strategy. CICT is involved in a government land sales, or GLS, site at Hugang Central. A consortium consisting of CapitaLand Development, UOL, and CICT won the bid for approximately $1.5 billion.
Which translates to $1,179 per square foot per plot ratio.
Right. The bid was awarded in January 2026. Here is the kicker. CICT will develop and retain 100% ownership of the commercial component, which is a massive 300,000 square feet. It will be the largest mall in Hugang.
A huge undertaking.
CICT's specific development cost for their portion is roughly $1.1 billion, and they are projecting a yield on cost greater than 5%. It will be funded by internal funds and external borrowings, and importantly, no preferential offering is disclosed for this either. The target completion is 2030 or 2031.
Right.
My question here is about risk tolerance. A typical REIT is fundamentally supposed to be a passive vehicle, right? They buy finished, stabilized buildings, collect the rent, and pass it on to shareholders.
That's the traditional model.
Why is CICT taking on the massive headache and the immense construction risk, cost overruns, labor shortages, supply chain issues, of building a 300,000 square foot mall from scratch in a 2026 inflationary environment? Why not just wait for someone else to build it, take all the construction risk, and then buy it from them when it's finished and stabilized?
It all comes down to the yield spread. We need to define yield on cost for a moment. When a developer builds a property, the yield on cost is the annual income the finished property generates divided by the total cost it took to build it. Buying the land, pouring the concrete, paying the architects.
Okay, so total cost versus income.
Right. We established earlier that in a constrained, tight market like Singapore, crime-completed assets are incredibly expensive. If CICT waited for another developer to take the risk and build a best-in-class 300,000 square foot mall in a major transit hub like Hugang, and then CICT tried to buy it on the open market, they would be paying a massive premium.
Like they did with Paragon.
Look at Paragon. They bought it at a 3.9% entry yield. But by taking on the development risk themselves, the sources state they are targeting a yield on cost of greater than 5%.
Oh, that's a big jump.
That extra 100 to 150 basis points of yield is a massive chasm when applied to a $1.1 billion capital base. It generates millions of dollars more in sustainable, recurring cash flow once the property is stabilized compared to buying it off the shelf.
I see. And they are hedging that construction risk by doing it in a consortium.
Precisely. They aren't doing it alone. They partnered with CapitaLand Development and UOL, two of the most experienced developers in the region. By doing this in a consortium, they spread the massive capital burden of the land bid. But structurally, CICT secures the golden goose.
Which is the commercial component.
Right. They get 100% ownership of the commercial recurring income component. You have to view this not through the lens of next quarter's dividend, but through a 10-year horizon.
Long-term planning.
When you look at an empire the size of CICT, they need massive new assets to move the needle. A $1.1 billion development completing in 2030 ensures that when the current portfolio reaches a plateau, there is a brand new, high-yielding engine ready to power the dividend into the next decade.
We need to talk about how they are managing the golden geese they already have in the coop.
The existing portfolio.
Yes. Let's look at how they are squeezing more juice out of the existing portfolio through asset enhancements and what I'm calling the reversion reality check. Because the capital expenditure numbers here are massive. Asset enhancement initiatives, or AEIs, are essentially massive renovation and repositioning projects. And CICT has a very robust pipeline.
Very robust.
The sources show the IMM building recently completed a regional outlet repositioning in Q3 2025. Then we have Tampine's Mall, where they are spending roughly $24 million in CapEx to add 50,000 square feet of net lettable area, or NLA.
Right, expanding the footprint.
And for that $24 million spend, they are targeting a very strong 7% return on investment, which is scheduled to complete in Q3 2026.
I want to highlight that 7% ROI. When we just discussed how hard it is to get a 5% yield building a mall from scratch, achieving a 7% return on investment simply by enhancing an existing asset is an incredibly efficient use of capital.
It's the lowest hanging fruit.
Exactly. It's the lowest hanging fruit for a REIT.
Right, and they are going after much bigger fruit, too. Look at Plaza Singapura and the atrium at Orchard. They are committing a massive combined $160 million for a structural infrastructure and tenant mix refresh, phased between Q3 2026 and Q4 2028.
A huge upgrade.
And overseas, they have the Galileo office in Frankfurt, where Phase 1 was just handed over to their anchor tenant, the European Central Bank.
The ECB.
Yeah, with Phase 2 coming in Q1 2026. And perhaps most intriguingly, right on the heels of the Paragon acquisition, they are already floating the potential for a massive, greater than $300 million AEI at Paragon, noting that its last major enhancement was way back in 2009.
It's overdue for a refresh.
So they are spending hundreds of millions to polish these assets. And initially, the financial metrics make it look like it's working brilliantly. Let's look at the rental reversions. The sources show that in FY 2025, the blended reversion across the portfolio was an incredibly impressive plus 6.6%. Broken down, retail was plus 8.8% and office was plus 11.1%.
Very strong numbers.
However, the Q1 FY 2026 update shows that pace is starting to moderate. Retail reversions cooled to plus 4.4% and office to plus 6.1%. Management claims this is expected and will support stable growth in the upcoming quarters.
That's the official line.
But I found one final data point from the 2026 AGM notes that feels like a massive flashing red light. While CICT was aggressively hiking rents by a blended 6.6% in FY 2025, the actual tenant sales growth, the amount of money the retailers were actually making at the cash register, was only growing at about 1%.
That is a stark contrast.
So what does this all mean? I try to visualize this as a rubber band. The tenant's business, their actual sales volume, is the anchor point. It's barely moving, just inching forward at a sluggish 1%. But CICT, the landlord, is grabbing the rubber band and stretching it violently, jacking up the rent by 6.6% to 8.8%.
The tension is building.
My question is, how long can you stretch that rubber band before it snaps? If the tenants aren't making more money, how are they affording these massive rent hikes year after year?
This raises an important question, and your rubber band analogy is the absolute perfect way to visualize the systemic risk in the portfolio right now. What you are describing is the physics of retail sustainability.
Right.
To answer your question about how landlords justify these massive rent hikes to tenants when sales are flat, we have to look back at those massive asset enhancement initiatives we just discussed. When a retail tenant complains that a 6.6% or 8.8% rent hike is unsustainable on 1% sales growth, the landlord, CICT, points directly to the $160 million they are spending on Plaza Singapura or the $24 million at Tampines Mall.
Ah, I see.
They argue to the tenant, we are giving you a shinier, more heavily trafficked, modernized mall. We are improving the end-of-trip facilities. We are bringing in the European Central Bank to the office tower next door. We are manufacturing the premium foot traffic that will eventually boost your sales. The rent hike is simply the price of admission to this newly upgraded premium ecosystem.
Ah, so they're saying, we built it, so you have to pay for it, and the sales will theoretically follow later.
Precisely. AEIs act as the political and economic cover for aggressive rent reversions. But, as an analyst, you have to look past the marketing and look at the raw math. You cannot consistently grow rent at 6% or 8% while the underlying tenant revenue grows at 1%. Eventually, the tenant's profit margin is completely erased by the rent expense, and they go bankrupt.
The rubber band snaps.
Exactly. While the plus 6.6% reversion looks amazing on a financial statement today because it instantly drives up the DPU, this divergence rent growth vastly outpacing tenant sales growth is the single biggest operational risk facing the business quadrant right now.
Wow.
It means the landlord is capturing almost 100% of the economic surplus generated in the building, leaving the tenants gasping for air. The moderation we saw in Q1 2026, retail dropping back down to 4.4%, is likely CICT recognizing that the rubber band was near its breaking point. They had to let some tension out of the system before they triggered a cascading wave of tenant defaults.
That is such a critical insight to pull from the data. To distill this deep dive down, CICT's business strategy is aggressive, but it is highly calculated. They are relentlessly exploiting a structurally tight supply market in Singapore.
Yes.
They are leaning entirely into the defensive mode of transit-oriented assets, effectively capturing the daily movement of the population. They are rapidly upgrading their portfolio quality via the massive leasehold for freehold swap of AST2 for Paragon.
Prioritizing execution speed even if the private placement funding ruffled some retail investor feathers.
And they are securing their long-term future growth by taking on development risk with the Hu Gang Central Greenfield project. But next time, we're going to dive into the balance sheet to see if the math, the debt load, the interest coverage, and the actual valuation multiples truly justifies a buy rating.